Hey folks, welcome to the Market Huddle Plus episode where we get a previous guest back on the show for a quick update. I'm Kevin Muir, and this week we welcome back Harley Bassman from Simplify Asset Management. It's our pleasure to welcome back to the show Harley Bassman, the managing partner at Simplify Asset Management and the originator of the Move Index. Harley, thanks for making time for us today.
Thank you. Thank you. I thought you were going to add Convexity Maven also, but that's okay. Today will be modest. It only goes 2 titles.
First of all, before we start, we're going to talk about 2 new strategies that you have, the TUA and the MTBA. But before we do, I just want to kind of give you a huge plug for your PFIX. And for those who don't know, this was the product that was, in essence, buying a swaption on 20-year, 7-year option on 20-year swaps. And it was, in essence, betting on higher 20-year rates. And you kind of brought this out last year, or maybe it was 2 years ago, and it was an absolutely stunning trade. It went from $50 to $110, and just hats off to you. It was well done.
Thank you. Thank you. It was a 7-year swaption into a 20-year payer. If you want to bleed it down, though, for simplicity, it was a 7-year put on the 30-year treasury. That's the best way to think about it. There's a 7-year put on the 30-year treasury bond. And yes, it was a winner last year, I think up 92%, because we brought it at 50. It promptly went to 37 at the end of 2021.
You can't get it perfect.
Can't get them all right now. And then Jay Powell, Jay Powell gets all the credit. He took this thing from 37 up to 114 last month. So it did what it was supposed to do, a positively convex way to get negative duration.
Well, I think it won on 2 ways. It won on the delta, meaning that the interest rates went up, but it also won on the fact that volatility increased.
Oh, yeah. I mean, easily 10 points of that was vol, because you were also buying this thing when the move was at 60 before it went to like 140. So, yeah, you made money on both sides of the trade. You lost money on the curve. But we made up for it everywhere else, so that's okay. I'll take a winner.
Okay, so that one was a long convexity trade, and you have the new one that you're coming out with, the MTBA, and this is a strategy where you're going to buy mortgage-backed securities, and it's a little unusual for you because usually, you mentioned that you're the long convexity maven, and this trade is actually shorting vol. Can you tell us a little bit about this strategy?
Well, it would seem oxymoronic, except for the small detail that I ran mortgage trading at Merrill Lynch. So I am
so you're always short.
I am a mortgage guy by training. Here's what. So I write a commentary. It's free. I post every 4 to 6, 8 weeks. You can find it at convexitymaven.com. My email is there. If you want to get added to the list, just ping me and I will add you. It's free, no cost. And my last 2 commentaries have gone through kind of the math of what's happening in the mortgage market. And what you've seen in the mortgage market, you could think of a mortgage as being a buy right, but a big, fat, juicy buy right. So not buying a security and selling a 1 or 3 month call. This is like buying a 10-year treasury and selling a 3-year call against it.
Okay, why don't you explain to people why that is? Just like what the kind of the why a mortgage is different than a regular bond.
So only in the U.S. and in Denmark, but we'll ignore them, can a consumer, homeowner, ordinary civilian take out a 30-year loan where the rate is fixed for 30 years, but at any time they want, they could prepay it for no cost. That's a gigantic mammoth option, a 30-year option. It's a very powerful option. And therefore, what that means is if you take out a loan, if something's on a mortgage of 5% and rates go to 6, well, he's going to go, he'll keep his 5% loan. If rates go to 4, he's going to refinance. If you own that bond, so what happens is the big mortgage companies are no longer banks, but they're like Rocket Mortgage or Quicken. Those are the guys who do all the mortgages now, not the banks. They will do, let's say, 10,000 loans, and they'll give them to Fannie Mae, who will look at them, stamp them, give them back as a single pool with a diversified group of 10,000 mortgages in it. those mortgages will all be prime, which means 720 FICO or higher. Doesn't really matter because Fannie Mae then stands behind that and guarantees the timely payment of principal and interest.
Okay.
So when you buy this bond, if rates go up, it will go down like any bond would. It can go down 5, 10, 20, 30 points. As a matter of fact, we have bonds right now that are down 30 points. Fannie 2.5, twos are down by that much.
Right.
But it really can't go up much above 105 because once it gets to that level, the underlying mortgage will be about 100 basis points in the money and the homeowner will refinance and you'll get paid back at par. And so it's negatively convex. Remember, what is convexity? Convexity simply means you have a non-linear payoff profile. So if I have anything, any asset or a bet where I could make a point or lose a point for equal changes in the underlying something, that's no convexity. It's linear return. If I could make 2 points and lose 1 point, positive convexity. If I could lose 3 and make 2, negative convexity. That's it. Nothing more, nothing less. If the up and down is not the same, it has convexity. And if you make more than you lose or vice versa, that's the number. Now, the reason why we hired all these rocket scientists in the 90s on Wall Street was to try and figure out what that option is worth. And for mortgage bonds, it tends to be worth about 3/4 of a point. So if treasuries are trading at 5, mortgage bonds trade at 575. And of course, the underlying mortgage inside of it will be at 650 to 7%, somewhere in there. The underlying mortgage will be usually, let's call it 1 point higher. That's because it's like all the fees and the processing for it.
Okay.
Right now, we're trading about 175 basis points over the curve. That's insane. And while I have made a career of being long convexity, as we say on the street, no bad bonds, just bad prices.
Oh, that's a great line.
There is a price I will sell convexity at, and we're at that price right now. So,
all right. So let's talk about why this exists right now. Why is that spread at record wides?
I will give an easy reason and a hard reason.
Okay.
The easy reason is that volatility has basically doubled. The move was at 60, now it's at 125. And since you're selling a 3-year option, not a 3-month option, that vega, that the value of taking vol up by a point or 2 or 3 on a 3-year option is really big. And so the mortgage spread is widened because the mortgage spread is just simply the value of the option. Fannie, Freddie, Ginnie bonds are basically full faith and credit of the U.S. government. They will not default. If you think Fannie Mae will default, you should get cans of tuna, small token gold coins, and a gun, because that's what will happen to the world if Fannie and Freddie default. It'll be the end of civilization. So it's not happening. Okay. So therefore, the only difference between a treasury and a mortgage is the value of that call option. And the call option is going up in value because vols have doubled. The other
so that's easy.
Yeah, that's
the easy reason. What's the hard reason?
Hard one is you have to go to my prior commentary called The Center Cut, issued on November 1st. Go to page 8 and read that. What it simply says is, as the yield curve has inverted, the call option has become plumper, has gone up in value. I'm not going to detail why. It's murder. But that is a key concept here, because if that option is plumped up because the curve inverted, what will happen when the curve steepens? The value of the option will go down.
Right.
That's really interesting with this ETF here, is that by buying it, you have an embedded yield curve steepener.
Okay. Now, one of the problems with people going out and just saying, oh, great, that's a great trade, I'm going to go buy mortgage-backed securities, is that there's different tranches or issues of these. Why don't you explain to people why it's important that you get the right group of MBS securities?
Okay. Civilians, you will never buy a tranche. That's from a CMO. What you're going to look at buying is a regular, plain, vanilla mortgage-backed security. That's the whole bond. Now, you're not going to buy it. You can't buy it. Well, if you have enough money, you could buy it, but even then, you probably don't want to. Generally, civilians cannot buy mortgage bonds. You think you can when you see Fannie or Freddie or Federal Home Loan Bank or Farm Credit. Those are the GSEs issuing securities. Those are not the actual mortgage-backed securities. Mortgage-backed bonds are hard to buy because the street does not want to sell them to you because they're just dirty animals. And they're dirty because they give you a monthly principal and interest. Just like when you take out a loan and you pay your $2,000 a month for your loan, and some goes to principal and some goes to interest. When you're the owner of the mortgage security, you receive that. And the accounting for principal is bothersome, to say the least. You will get a 1099 in February. You'll get a 1099 supplemental in May. You're not going to like it. So in general, Wall Street does not want to sell you these bonds. What I've given you is basically the only way to buy a specific mortgage bond, which is right now Fannie 6s. You can buy them with the mortgage index investments, either a mutual fund form or the biggest one out there, the mortgage index ETF, whose ticker I can't say, but you can.
Okay.
Here's the problem with that. 72% of all mortgage bonds have a coupon between 2 and 3.5.
Okay, so explain to people what that means.
When the Fed took rates down, everybody refinanced. And so people who took out a loan at 2.75, that loan would get put into a Fannie Mae 2.
Okay.
And so on and so forth. Most of the mortgages in the U.S., 3/4 of them got refinanced into very low coupon mortgages that then got put into very low coupon mortgage-backed securities. These bonds are not, well, they're not very good for anything, truth be told. They trade at a Fannie 3, a 3% mortgage bond, basically mimics the mortgage index. It's trading now at about $83 price. The problem is, at that $83 price and a 3% coupon, your dividend, your payout is only 3.6%, despite the fact that mortgage bonds are trading at 6. So you're supposed to make back this, 17 points over the next, 30 years, which is suspect, to say the least. These are not great bonds. Moreover, these bonds have very long durations. Fannie 2s and 2.5s have longer durations than the 10-year note. And what you've done to make your measly yield on these things is you've sold it very far out of the money call. Remember, the strike price I said was 105. When you create a mortgage bond, it can look like buying a treasury at par at 100. It's like a 3-year call struck at 105. The Fannie 3 still has a call struck at 105, but the bonds trade at 83. So you're 22 points away from being at the money. You're basically selling an option for a tail option for pennies. You don't sell options for pennies, okay? If you're going to sell an option, I'm not saying you should. If you're going to, you sell it closer to the money so you can get some meat in it. Take some income into it. Selling off the tail is preposterous. So the mortgage index is basically a lousy investment right now. And what I'm proposing is you sell the mortgage index, which looks like a 3% bond, and buy my new ETF that only owns 6% bonds issued this year. I'm skimming off all the bonds issued in 2020 to 22, which is most of the index, and only letting you invest. Well, I'm offering you the ability to invest in new bonds that have been invented this year. And they trade with a much higher yield, a much higher coupon, also a much shorter duration, which we could talk about in a second.
Sure. So why don't we do it? Why don't you explain to people what you mean by that?
Well, the Fannie 3 trades like a 10-year because the option's so far to the money, it's basically worthless.
Right. So
it's like a 10-year note of sorts. A Fannie 6 trades at 99.5. So, we move 50, 60 basis points from here. We're going to get in that thing near the call level. So it has a duration of more like a 4, like a 5-year note, maybe even less. You're getting a lot more yield for it because you're selling a big, fat, juicy option. If you think the market's going to stay in the range for the next, while, and by range, I mean up and down 50, 75, then this is a great ticket. You're going to get a lot more yield and a lot less volatility. If you're concerned about rates being a lot lower, what I would do is actually sell the mortgage index security, buy my new ETF, and then go and buy back some duration. You can buy back one of two ways. One is to buy the 20-year Treasury ETF, which is fine. The other is to go and buy a levered 2-year ETF, which we have produced. We've created an ETF that offers a 5-to-1 leverage on the 2-year note. So basically the same duration as the 10-year, but based upon the 2-year yield, not the 10-year yield.
Harley, you're Harley, you're such a pro. I don't even need to do the segue. Okay, so we're going to go from talking about MTBA, which is the Simplify MBS ETF with these new MBSs in there, to the TUA. And this strategy is buying 2-year levered kind of futures in essence. And why don't you explain to people why this trade might be more attractive than just going out and buying a 10-year or a 30-year bond?
This is our biggest ETF right now, very popular. We were a little early on it, but whatever, you can't pick the bottom. So why is the yield curve inverted? That's really the question you got to ask. Like, why would someone want to go and take less yield for a riskier bond? At one point, why was the 10-year yielding 100 basis points less than the 2-year? The reason why is people want duration. They want some ammo. If rates go down, they want to make some money, okay? A 10-year will make about 8 points. If rates go from 5 to 4, that 10-year bond will go about 8 points. A 30-year bond will go by about 17 points. A 2-year bond will go by about 1.8. That's nothing. It's a nice yield, but you're not getting any ammo for it. So people kind of have to battle back and forth. I think we're going to a recession. I think the Fed's going to cut rates. I think rates all rates are going to go down. I want to go make some money. 2 years is for babies. By the way, I never traded the front end because it's for babies. So what do you do? Well, what you could do is what we've offered and said, you know what? We'll give you the 2-year, but we're going to do it by doing it in futures at a ratio of 5-to-1, more or less. So when you buy that 2-year ETF, there's 5 futures in there for every dollar you invest. So it moves like a 10-year, has a duration of about 8 and change. That's very interesting. And the reason why you like that is when the Fed cuts, they will cut. I disagree with my partner, Mike Green, about when that will be. I think it's not till next year later, but they will cut. They're slamming on the brakes, and eventually they'll slow the economy down and they'll cut rates. When they do that, they cut the front end. They don't cut the back end. Here's how it's all going to play out, in my prediction. Their inflation target is 2%. They're going to want a 50 basis point real rate. So that puts funds at 250. The historical relationship of Fed funds to the 2-year is 50 bips. So that put 2 years at 3%. Historical relationship of 2s to 10s is 100 bips. That's 4%. What's going to happen is that 2-year is going to go from 5 to 250, but the 10-year is going to go where? From 450 to 4? It's not going to move that much. The real ammo is going to be at this front end, but owning an unlevered 2-year, you'll make nothing.
Right.
5-to-1 levered, well, now you're really making something. This levered 2-year is going to move 20 odd points.
Now, sorry, I didn't mean to interrupt. First of all, I just want to kind of reiterate one of the things that Alex Gurevich says. He says that easing is steepening. And I think that's one of the things that people don't understand is we could have a situation where the Fed actually eases and you've kind of crafted a scenario where the 10-year it actually goes down in yield. But you could also make the case that it's going to, the yield curve might steepen the yield curve might steepen enough that it actually means that the 10-year not only doesn't it go down, it could go up in yield.
Oh, I have no problem with that at all. I have zero problem with that.
Right.
I'm just trying to be generous here.
Right. And I think that's what people kind of mistake. They think, I think that the economy is in trouble. I'm going to go buy 30-year bonds because they're going to move the most when interest rates move. But the trouble is that if the interest rates at the front end are where the real juice is, then you're not going to actually benefit as much from owning the 30, and it actually might be a losing trade.
I can assure you this, do not buy 30-year zeros. That's a suicide trade because 30-year zeros trade negative to the 30-year treasury bond. I'm not going to tell you why. I'll just say it's the case. Please do not buy long-dated zeros. Okay. That's suicide.
Okay. Now, one of the things that you mentioned is that when they cut hard. And I just kind of, we're going to talk a little macro here for a quick second. I kind of went through and looked at 2000, and the 2000, we went from 6.5 down to 1. And the meat of the move down to 1 3/4 was in about a year's time. Then in 2008 or 7, sorry, it started in 2007. We went from 5 1/4 down to basically 0. And that all happened within a year as well. One of the things that kind of strikes me is that people say, oh, the Fed's going to cut 50 basis points next year, according to the curve. Isn't the curve actually incorporating different probabilities of either like 0 or 200 basis points?
Okay. Number one, I have never said the Fed's going to do a hard cut overnight. I've never said that.
No, fair enough. I'm just kind of saying in the past, this is what has happened.
Yep. So what you're looking at is this. If you look at the current 1-year rate versus the 1-year rate 1 year forward, which is like down 100 basis points from here, that's where people are kind of ginning up this notion that we're going to see that the market's predicting a big cut in interest rates. So right now, the 1-year rate is 5.2. I'm looking at Bloomberg right now live. And the 1-year forward SOFR rate is 4.1.
Okay.
So that one might say the market's predicting that we're looking for a 110 basis point Fed funds cut over the next year.
Got it.
Number one, forward rates are not a prediction. Never say that to me. I might hit you. It angers me greatly.
Okay.
They're not a prediction. Forward rates are simply the mathematical break-even of an arbitrage-free condition. That's all it is. Now, when you have an inverted curve, why is the curve inverted? One could say, well, that is telling you something. It's true, but it's not a prediction, but it's somewhere in between. This 110 basis point spread between the current 1-year rate and the 1-year forward 1-year rate, here's my pet theory, which I've stated many times in the past. The market's not saying we're going down by 1% or 1.1%. What it's saying is there's a 90% chance rates will be unchanged and a 10% chance rates will be down by, 400. There will be power windows down, hard landing, hard crash, Fed cuts back to 0 again. If you add up 85% times 5.2 and 15% times 1, well, there you go. That's how you get your 4.1% forward rate. It's not really a prediction per se. I think it's a massive bimodal distribution of either A, we're unchanged, or B, we crash and burn. And that gives the average of that is 4.1 or 100 basis points, but that's what I think is going on here. And my guess is the Fed doesn't cut till third quarter next year.
Okay, so can we talk about that? Why do you feel that way? And if so, then it's still too early for the TUA.
Let's talk about humanity.
Okay.
We read the Greek tragedies from 1,200 years ago. We read Shakespeare from 500 years ago. Why do we read these things still? Because they've captured the essence of humanity, which is that the great failing is always hubris. It's always ego. And I don't got to go too far in our current politics to go and point to, it's kind of all ego, without scratching too hard. Jay Powell is worth a lot of money, or so I've been told. I'm quite certain he has a lovely wife and kids, nice house. What's left for the guy? His legacy. Does he want to be known as Arthur Burns, who people spit on as they walk by his grave because he, did not kill inflation when he could have? Or Paul Volcker, who is a modern day hero? I'm going to guess it's Volcker, which means he is not cutting rates until he knows inflation is dead in the ground with a stake in its heart. And that's not going to happen until he has core PCE with a 2 handle for 6 months, or his unemployment 4.2 to 4.5. That's a good take. He's not reversing early. He will take no risk. His legacy is tarnished by him releasing too early. It's not economics. It's not math, money, numbers. I'm talking just pure ego of what he wants to do for his legacy. And that's it.
Okay. And so if that's the case, that means the Fed stays tighter for longer. Probably means there's more pressure on financial conditions. If we have to assume that they put us into a kind of a tightening, a point where we're restrictive, and it also probably means the yield curve inverts more, doesn't it?
Not necessarily. It depends. When the yield curve inverts, there's ordinary civilians who own 10 years versus 6-month bills, and they're giving up 100 basis points in yield. That's not a cost. Well, it's an opportunity cost. It's not out of your pocket dollar cost. Now, all the hedge funds, all the levered money, they actually are writing a check of negative carry.
Right.
So the question is, how long can they carry a trade for? I will tell you, it's a lot shorter than what, a civilian can. And so that's what kind of drives this thing is levered money. How long can they hold the trade? Now, if you go look at my levered 2-year ETF, this is actually a long convexity, long theta trade, because we go out there and buy 5 futures contracts. Those futures, I'll save you the math, they yield negative 0.5%. Okay? Forget why. So I got 5 of them. That's negative 2.5. I'm making, 540 on 3-month paper.
Right.
So I'm actually making like a 2.4%. Sorry, is that right? 2.9% yield on this puppy. So I'm earning 2.9, almost 3% on this levered 2-year ETF. And what's convexity? Convexity, again, is relative up and down. Do I think rates can go higher? Unlikely, but okay, maybe 100 higher. Okay, maybe 100 higher. Take Fed funds to 6.5. Downside, I just told you they could probably go to 2.5, likely. So you could, lose 1, make 3. I call that positive convexity. Right. Can I measure the value? Not particularly, but on its face, that is long convexity, and you're earning almost a 3% yield while you're long this convex profile. I think it's a pretty good deal.
Yeah, and when I was doing the math and chatting with you about this before the show, I was thinking about it like a hedgie and thinking to myself, okay, well, if you're levered long 2s, the overnight, the repo is trading at 540 or whatever, and 2s are yielding whatever they are, and it's negative. And then you reminded me the fact is that no, there's the money that is sitting in the ETF that is actually earning that interest. So I guess yes, it is the opportunity cost of owning just a straight 2, which would earn you 5% or whatever it is, versus the owning this, which has less of a current yield. But then if we do get a situation where rates go down a lot, it cleans up.
Well, let's put pencil to paper. If I have rates down by 250 basis points on the 2-year, so from 5 to 250, or 5 to 3, let's say, that's 16 points, right? 8 duration times 200 bips, that's 16. The 10-year is going to move 50 in my scenario. That's 4.
Right.
I can make 16 points with the front end, 4 with owning the cash 10-year. So I think I like this profile a lot better.
And not only that, as we've said, easing is steepening, and there's a chance that even with the Fed lowering rates, that you're not actually going to win at the 10-year.
And if we do go hard landing, 2s are going below 3.
Right.
Okay. So I mean, it's a very timely trade. It's probably the best hedge out there now for a recession, I think.
And this is a trade that has been kind of old as time amongst the hedgies, right? Like our mutual friend Morris Sachs, he talks about how he did this trade with Paul Tudor Jones, and he did it with 5s back in 1987. But this is a trade that is kind of when people want to express kind of worry about the system and the potential that there's a financial accident and the Fed has to go cut rates, this is the way to do it.
Well, I don't know him personally, but I did see a tweet that said that Druckenmiller came out and said he is massively levered long twos.
Yes, he is.
Well, so if you want to go and pretend you're him, but you're a civilian with just a Robinhood account, this is how you do it.
Well,
5-to-1 leverage.
You're telling me he doesn't own TUA?
That'd be nice.
Listen, Harley, it's always great to have you on the show. Why don't you tell people where they can find more about you? You did it early on, but just why don't we remind everyone one more time where they can chat with you and find out more about you and your great products?
So I'm the Convexity Maven, convexitymaven.com. You can find me there. I'll add you to my list. And our products are all at simplify.us. Simplify.us has all of our products there. They're very clever. And just to remind you, I came out of retirement to join this firm because what happened is there was a rule change at the SEC a number of years ago where all of a sudden you could put derivatives, futures, options, swaps, all these nice professional tools, you could put them into ETFs. You couldn't do it before. You could do it now. And so we started a company where we put professional investment tools into ETFs so civilians can trade like professionals at a very low fee.
Yeah, no, it's absolutely fantastic. And if you think about the strategies that you've introduced, the first one you needed an ISDA to do with the PFIX. This one, the TUA, you need to use leverage, which a lot of people don't want to do, and they don't want to be rolling it and taking care of all that. And then finally, with your new MBS, almost nobody except somebody that used to work as the head of Merrill Lynch's mortgage-backed securities can buy those things. And so I just want to thank you because I think it's a great suite of products that you've offered for everybody.
Thank you very much.
Thanks, Harley. Thank you for tuning into this Market Huddle Plus episode. And don't forget that our regular full-length show airs every second weekend. This Friday, we're looking forward to chatting with Peter Bookvar about the challenging macro environment. In the meantime, you can check out my partner's website at bigpicturetrading.com. And if you want to see what I'm up to, go to themacrotourist.com. Until next time, I'm Kevin Muir, and thanks for listening.